Hello, everyone. Thank you for joining the BuySide 50 today for our panel on embracing ESG standards and technology solutions. I'm joined by our panelists, Wei, Elizabeth, and Fate, who I'll invite to introduce themselves now. Oh, Wei, I think you may be on mute.
Oh.
Perfect.
Good morning, everyone. My name is Wei Shi. I'm professor of management at Miami Herbert Business School. I do research related to ESG. Thank you.
And hi, I'm Elizabeth Seep. I'm joining you from Rhymes Technologies, where I lead the sustainable investing product. Rhymes is an enterprise data management company. We are an aggregator of ESG data, and we bridge the gap between ESG data and the investment community to make that data usable for our clients.
Hello, good morning, everyone. My name is Fate Seguir, and I lead sustainability at sustainable investing at Mackenzie Investments. We are a $200 billion asset manager located in Toronto, Ontario.
Amazing. Thank you all for joining us for this wonderful panel. Just briefly, I'm a senior researcher with Chartis, and I'll get into the panel now. So the concentration of this panel is on the regulatory environment and data environment in ESG and climate. The regulatory environment and around ESG and climate policy is evolving rapidly. Investors have been challenged by the need to digest complex regulations globally while also navigating stakeholder expectations. ESG data and scoring solutions are part of the answer, but they are also under scrutiny and potentially regulation within the EU. We'd like to use this panel to talk a bit more about what we're seeing in the ESG disclosure and data-driven assessment space, particularly in North America, where all of our panelists are based. And I did want to mention this panel is open to audience Q&A, so as appropriate, please insert your questions in the chat and we'll do our best to answer them. So to kick off our panel, I wanted to discuss a lot of the focus within the ESG investing space currently is on Europe, particularly with regards to the investment flows as well as the regulation. That being said, all of our panelists today are based in North America, which has been receiving less focus. Could you each potentially speak to some of the trends you're seeing in the ESG investment space in North America today? And I'll give this to you, Fate, to start.
Great, thank you so much for the question. Yeah, it's interesting because for us, we are the majority of our operations are Canadian based, but we also do have business and investment professionals in the U.S. So we're impacted by both sides of the border, and it's it's so great that this week the International Sustainability Standards Board released their S1 and S2 disclosure standards. These will be voluntary standards for all of us. And what I find very interesting in comparing the two countries, us here in the north and our neighbors to the south, is Canada set up a Canadian Sustainability Standards Board shortly after the ISSB was established, and the intention of this board is to take the recommendations of the ISSB and starting with this S1, which is more general material disclosures, and then S2, which is focused on climate risks and opportunities. The Canadian Sustainability Standards Board will take that and determine and make recommendations to the regulators in Canada as to what should be made mandatory. So that's a little bit of a difference, and we expect much of what the ISSB is putting forward will be adopted in Canada for reporting, which is really good to see. Some of the other notable differences that we see is generally the Canadian regulator has really followed suit to what the SEC might be doing, right? And some of the regulations that are being implemented, not always, but for the most part on some of these bigger topics and issues. And on sustainability, we're seeing the CSA in Canada is kind of trying to figure out, what role are they going to push a little bit to where the Europeans are, which is much more very prescriptive, or are they going to remain today? We're seeing they're very much disclosure based and less prescriptive, which still creates a little bit of ambiguity. But we expect now with these disclosure standards being released, we're hoping that will be a little bit more prescriptive in what's being put forward. Some of the other, you mentioned flows in your questions, in your question. some of the other things that I find very interesting is in Canada, we're still seeing positive flows into sustainable investment funds. So these are funds that prioritize ESG or sustainability in their investment objective. In the US was one of the markets that started experiencing outflows from those funds last year, right? And I imagine a lot of that was sentiment driven, right? This anti-ESG movement and so on might be somewhat maybe contributing to that. But in Canada, we saw there was a retention of assets in those funds, whereas the overall market actually, there was net outflows in the Canadian market last year, except for those sustainable funds. So I always say to advisors, if you're selling beyond performance, you bet your clients are going to expect a little bit or be comfortable with a little bit of market volatility and want to stay invested, which is really important for us as a long-term investor. Some of the other things I'll highlight as well from an institutional perspective, institutions in Canada are still really focused on managing ESG risk in their portfolios. This continues to be a priority for us. And I, if I can speak on behalf of all of our Canadian peers, it's something that we still talk about. We get questioned on in RFPs and DDQs as we're completing those. I think in the US, we're feeling that there's a little bit of less of a focus, or at least less of a vocalization of things around ESG risk and ESG integration in the process. The last thing I'll mention that I'm really excited about in Canada is last year we released a draft of a taxonomy that's essentially, a little bit similar to what the Europe put out in terms of their green taxonomy. The Canadian taxonomy, the draft has transition activities as well as green activities, and those transition activities make it really unique. There's only a couple of markets overseas that are piloting and adopting such taxonomy. So really excited to have Canada be at the forefront, and as a resource intensive country, being respectful and accommodating to some of those transitional activities is going to ensure that we're not, this transition is not a switch, right? You can't shut off everything overnight and move to green. We still need to make investment in those transitional activities to get us to more of the green activities that we're all aspiring for. So it's just, I'm always like sitting back and looking at both sides of the border. And while, I have many cousins and family in Michigan, I still sometimes find where we've got very different priorities when it comes to sustainability.
And yeah, thank you for that, Feda. It's really interesting to hear that the Canadian regulatory and investment environment is closer to that of Europe in some ways than the US in the sustainability aspect. Did anyone else want to sort of offer their thoughts on this topic currently?
Sure, I can jump in and take it over to the US side. So like Fate mentioned, in the US last year, for the first time since ESG investing grew into an industry several years ago, yes, we had a very complex year in 2022. According to Morningstar, the US makes up 11% of the global 2.5 trillion ESG funds of assets under management. And last year, we had outflows for the first time ever, and we continue to. In Q1, also according to Morningstar, we had net outflows from US sustainable funds of 5.2 billion. So it hasn't accelerated, but the outflows continue to persist. 2022 was a pivotal year for ESG. For the first time, some of these funds underperformed due to low weights in oil and gas and higher weights in tech. So it was really a transitional year for ESG, along with a lot of political sentiment around ESG in general. And on the second point, I think it's always good to consider when we think about ESG regulation. Fate mentioned it. She mentioned the word voluntary. A lot of the ESG regulation is indeed voluntary. There is some mandatory, particularly out of Europe, but really what the asset management community is exposed to is a lot of reputational risk. They've made commitments to the PRI, to the TCFD, to net zero. And net zero is something we are seeing really shift. A lot of commitments were made and some are being pulled back due to concerns in the US about litigation. So a lot of these regulations, while they're not quote unquote mandatory, they're still really important to the investment community and putting their reputations on the line. And thirdly, we also see that most of the US asset managers are quite global in nature. So we have to consider that global regulations continue to have a big impact on the US, even despite what the SEC does. So large asset managers, large corporations are starting to fall under the umbrella in a lot of these EU mandatory regulations as well.
Well, there is a lot happening in the regulatory environment and the investment environment that we couldn't possibly cover it all during this call. One of the aspects we wanted to shift the conversation to concentrating on as well is sort of the data. Raters and scorers who are helping investors navigate the corporate disclosure landscape and the regulatory environment and transition finance are under scrutiny due to perceived inconsistencies of ratings, and increased attention is being turned to what is inside the data. Given that each of you occupy a different role in the ESG ecosystem of practitioner, technologist, and academic, we'd love to sort of hear you all share your perspectives on what you're seeing with regards to the challenges and opportunities around ESG data and scoring that investors should be aware of. And I'll give this back to you, Elizabeth, to kick this off as well.
Okay, great. Yes, I have the luxury and the purview of working with 30 different ESG providers in the market in my role as product here at Rhymes. So I really do get to look at a lot of this data. And I think having been in this space for more than a couple decades, I really do think that the ESG ratings really fulfilled a vacuum for a long time that existed in the market, which was, how do I get that sustainability view for the companies I'm investing in? Or if I'm a corporation itself, how do I portray my sustainability strategy to the market? And over time, we've reached now what I would call a real kind of paradox that can't exist in the market, where surveys are saying that while we're at the peak of usage of these ESG ratings from ESG integration and products, and these ratings are really important also to corporations when they're thinking about cost of capital and how they access the investment market. We're at a peak as far as the usage of the ESG ratings, but we're also at the peak of the most frustration from the investment community and corporations with the quality and usefulness of those ratings. So I think we're really at a moment that can't coexist forever. Things are going to have to change a bit. And I know Wei can get into some of that, but this isn't a new trend per se. I just think that we've really reached the point where we can't coexist in the way it works today. From my side, I see our clients who are mostly on the buy side are asking for a lot of data, raw data from CDP, SBTI, open source data, because they have grown their in-house knowledge of ESG over the last decade and have their own opinions and are creating their own ratings and scores. So really that vacuum doesn't exist in the market that once existed. So, and other data trends, are all around. Clients are looking for a lot more climate data rather than ESG scores. And then it's really about the challenge at this point is really about how to make all that data usable in the investment processes. The data is very different than what a chief data officer at an asset management firm might have typically looked at, from both volume, quality, governance, transparency. So that's where actually using all of this data becomes quite a challenge. And then I think you'll touch on the regulation that's been proposed out of Europe, that, and I think I had the quote here, the most important thing that will continue to shake up the ESG rating industry is that they suggest, the European Commission suggests that ESG rating providers should not offer consulting, credit ratings, benchmarks, investment activities, audit, banking, insurance, or reinsurance. So obviously, we are going to see some changes when it comes to those providers.
So I would like to take this opportunity to share some of my thoughts on ESG rating, the industry overall. So the industry over the last decade has evolved a lot, and we have seen kind of dramatic increase in the number of rating agencies, especially in the United States. So the industry itself right now is not very consolidated. So when we think about credit rating, there are actually only two big players. But you think about ESG rating industry, there are many players. So what I can kind of predict in the long run, there will be a lot of consolidation in the industry. The consolidation, from my perspective, might be in the interest of consumers of who are using this rating. And most consumers of using the ratings are investors. And so the investors, and I think, have potential benefit from consolidation in the ESG rating agency, rating industry. Another point I want to highlight is investors, they are users of or consumers of ESG rating, but at the same time, investors may unintentionally potentially affect the ratings they will consume. So how could that happen? You think about the rating agencies. Some are publicly traded companies, some are private owned, and they have their own investors. And oftentimes, these investors are consulted when rating agencies try and come up with a rubric in terms of what dimension should be rated. In the process, investors, they have influence in terms of influence rating. For sure, I think this is great in the sense that the ratings become more relevant, at least to investors, but at the same time, makes it very difficult for comparison of the rating from different agencies, because the investors of different rating agencies, they're kind of different. They have very different investment objectives. So this is one thing I want to highlight. Another thing I will highlight is you think about investors, especially institutional investors, they probably want more disclosure from companies, and in the process, and the disclosure become raw data for rating agencies, right? Rating agencies' data source come from basically two data sources. One is based upon archival data analysts can potentially collect from firm disclosure. Another data source is the rating agencies can send out surveys or questionnaires to companies to be rated. And these are two key data sources used by rating agencies. But you think about, if a firm you want to be rated better by a rating agency, you need to disclose more. But in the process, when you disclose more, investors have the information, rating agencies have the information, they probably are able to better rate your company's ESG performance. The problem is, and when you disclose more, that information also become available to any company, in potentially to your competitors. And when we think about these days, the disclosure is important, but the more a company discloses, the more your rivals know what they're doing. Think about environmental disclosure, and I think SEC is considering some regulation in that space. But you think about, for some industry like chemical industry, when you disclose very specific information on your environmental footprint, that potentially can be used by your rivals to inform in terms of your manufacturing process. So that can potentially may not be in the interest of shareholders who really care about firms' long-term competitiveness. So let me conclude here. Thank you.
Well, I think there were a lot of interesting points you both touched on, especially getting into sort of the potential weighting and last sort of editorial decisions that can factor into ratings methodologies depending on the approach. And Elizabeth, how you touched on how investors are increasingly turning towards primary data to perhaps mitigate some of those concerns. This is a nice segue into sort of another aspect of ESG, which keeps coming up in conversations in around the regulatory environment, especially in North America, which is greenwashing. Whereas in Europe, regulators are at least forcing investors to formalize definitions of sustainability, even if it isn't entirely prescriptive. In the US, and from what I understand, Canada potentially as well, we're taking a slightly more open-ended, maybe not slightly approach on this same topic. How should investors be navigating the topics of greenwashing and ensuring that their portfolios are aligned to their intended mandates and investor policies? And Wei, I'll give this back to you to kick this off as well.
Yeah, definitely greenwashing is something of great concern to investors who really care about a firm's ESG performance. And so for investors, if you really care about a firm's environmental or social performance, you want companies to take actions and really improve the long-term environmental or social performance. But oftentimes, when we think about this governance mechanism used by firms to incentivize firms, investing in ESG, think about, over the last few years, many companies start to adopt executive ESG compensation metrics. So basically tie executive compensation to a firm's ESG performance. So that's great in the sense that provide incentive for executive to improve ESG performance. But you think about executives, when you have the compensation, your compensation tied to ESG performance, that also provides motivation for you engage in greenwashing, right? And so a lot of the governance mechanisms, investors, they would like to firms implement, would like the board implement. The intention is great, terrific. But oftentimes when we don't carefully design the mechanism in a way, then that can be problematic. So back to the executive compensation relate to ESG. If you only tie executive compensation to short-term ESG metrics, that can be problematic. But if you tie, say, long-term ESG metric, let's say the metrics you set in 3 or 4 years, and then it wouldn't be a huge problem because managers, you have to focus on long-term a firm's ESG performance instead of just short-term, what you can do to boost your ESG performance as a way to get a higher compensation. And also in many cases, executive, they know that if they know their investor base. So let's say executive, they know a firm, largely owned by many ESG investors, they may engage in greenwashing in some way to keep these investors not from selling off their holdings. So this is also critical for investors to consider. Do you really just want to make your investment decision based on a firm's ESG rating? You just want to use ESG rating as your portfolio selection decision, or you really want to engage a firm? So I think engagements can truly help a firm improve ESG performance. But if you simply, investors simply just say, okay, I only invest certain companies with certain ESG ratings, then that is comes to the decision that makes it easier or actually give more motivation to managers to engage in greenwashing for companies engaging in greenwashing.
Wei, you brought up some really great comments on just around the competitiveness when in your earlier response when you talked about not wanting to disclose because maybe the company, if it's a chemical company, the competition might know exactly what you're doing and what your processes are, and that's and that might impact shareholders. And I think I think we're all on the same page, but I think there's two sides to this coin. The other side is, and Elizabeth touched on this, where companies are not disclosing, then these rating companies today are having to develop they have their own methodology to basically put a number, right, to create, and it's a thoughtful number, right? It's somewhat scientific, but they will report on your behalf. And so then us as investors, right, and practitioners, and we're out there, we don't have we're trying to make use of all the information that we're given. So it really I don't know what the right answer is. I like transparency. I'm very keen on disclosure, and I think if there is a competitive advantage that you have that I don't think those could be easily replicated. I'd hope not anyway. Otherwise, I don't know how much of an advantage it really is. And I think it's important that we move. I agree with you, and I think Elizabeth said this as well. Like, we need to move away from these high-level ratings, because I think they were a great way to get us all started, to get us all comfortable with the data. But now as disclosure standards start to come to the forefront, I think it's important for investment managers to really, think about their investment philosophy, think about what their thesis is, what their views of the world and the markets are, and think about, what's material and what's important for the way they invest. That's where we found success. We have, 16 investment teams. And when I came into, our team's about 3.5 years old now. If I came in and said it's a one size fits all, we're gonna, I'm asking, 16 at the time, I think we even had 17 boutiques, we're gonna do it this way, they probably would have locked the doors and never let me in into the building, or even into the team's room. But we approached it and saying, what is authentic to your investment philosophy, and developed unique approaches that, still are in line with what the PRI's expectations are of us. Or we're part of Net Zero Asset Managers initiative as well. We're respectful to those frameworks, but we've created something that's authentic to each of our teams. And I think, it's not perfect. It's a work in progress. And as we get better disclosures, we hope we'll continue to evolve. But I think it's, we need to be transparent. Otherwise, we'll never be able to move forward together, right? And that's the big gap for all of us right now.
I think you both offer some really interesting perspectives on the challenges of the governance, the sort of particularity of perhaps addressing some of these gaps in greenwashing, and really how it can introduce some elements of subjectivity, but at the very least, when things are clearly documented and explained, it becomes more readily possible to mitigate these risks. If not, I think this was a fantastic discussion. Thank you all so much for your thoughtful and helpful contributions, and we'll be off to the next presentation.
Thanks, everyone.
Thank you so
Thank
much.